Underreporting income. This is the most common form of tax fraud and the most invisible. This is when you make money and simply don't tell the government about it. Cash businesses are the classic example. The restaurant owner who rings some sales through the register and pockets the rest. The contractor paid in cash who keeps 2 sets of books. The freelancer who reports half their clients. It feels victimless. The money was already yours. You earned it. Why should anyone else know? Here's the problem. The IRS doesn't just take your word for it. They cross-reference. They compare your lifestyle to your reported income. They look at bank deposits. They talk to the people who paid you, because those people deducted the payment on their own taxes. The paper trail exists whether you built one or not. And when the numbers don't match, they come looking. The IRS runs every return through a scoring model that flags statistical anomalies. If your reported income doesn't match your spending patterns, your bank activity, or what your clients reported paying you, you become a target. And the reachback window for fraud has no expiration date. False deductions. Here's where people get creative, and creativity in taxes is extremely dangerous. A deduction is a legitimate expense that reduces your taxable income. A home office, business travel, equipment. The fraud version is inventing those expenses or wildly inflating them. The person who claims their family vacation as a business trip. The executive who writes off personal meals as client entertainment. The self-employed worker who deducts their entire mortgage as a home office when they use one corner of the living room. The IRS has seen every version of this. They know what normal looks like for your income level and your industry. When your deductions look nothing like your peers, you become a target. What feels like bending the rules is technically perjury. You signed the return. And that signature matters more than most people realize. It's a legal declaration that everything on the document is true. Inflating a single line item by a few $100s is the same category of crime as fabricating tens of thousands. The scale changes the sentence. The crime is identical. Offshore accounts and hidden assets. We're operating at a different tax bracket here, but the mechanics matter to everyone. Wealthy individuals have historically moved money into foreign bank accounts, shell companies, or trusts in places like Switzerland or the Cayman Islands. The goal is simple. If the government can't see the money, they can't tax it. For decades it worked. Then it didn't. The U.S. passed laws requiring foreign banks to report American account holders. Whistleblowers started coming forward. Governments started sharing financial data across borders. The people who thought their money was invisible discovered it was just delayed. The penalties for undisclosed foreign accounts are savage. Civil fines alone can reach 50% of the account balance per year. Not per offense. Per year. And that's before criminal charges enter the picture. The individuals who built these structures spent years feeling untouchable. Most of them eventually found out exactly how touchable they were. Payroll tax fraud. This harms more than just the government. It harms the employees directly. When you run a business and pay people, you're required to withhold taxes from their paychecks and send that money to the IRS, Social Security, Medicare, federal income tax. It gets collected on behalf of the worker. Payroll fraud is when employers take that withheld money and don't send it. They hold it. They use it for operating expenses. They tell themselves they'll catch up later. Sometimes they never do. The workers believe their taxes are being handled. They're not. When those employees eventually retire and try to access Social Security benefits they believe they earned, the records show gaps that aren't their fault. There's also a softer version of this. Misclassifying employees as independent contractors. Contractors don't require the same withholding, the same benefits, the same legal protections. So some employers relabel their workforce to avoid the cost. The IRS specifically scrutinizes this. The criteria distinguishing an employee from a contractor are detailed and deliberate, and claiming ignorance has never been a successful defense. Identity theft and refund fraud. This is the most jarring category because the immediate victim isn't the government, it's you. Criminals obtain Social Security numbers through data breaches, phishing schemes, or purchased lists on the dark web, and use them to file fraudulent tax returns before the real person does. They claim a large refund, direct deposit it into a prepaid card, and disappear before anyone notices. You go to file your own legitimate return and the system flags it. One has already been submitted under your name. Now you're navigating an IRS dispute process to prove your own identity while someone else has already spent your money. Resolution can take months or years. The government loses billions to this annually. Organized criminal networks treat it like a business, filing thousands of fraudulent returns during peak tax season with the efficiency of a corporation. The IRS has built increasingly sophisticated filters to catch anomalies, but the fraudsters adapt every season. It is a permanent arms race, and ordinary people are consistently the collateral damage. Failure to file. This sounds almost too simple to be a federal crime. You just don't submit a return. No elaborate schemes, no offshore accounts, no fake receipts. You just don't file. For some people, this is deliberate. They know they owe money and they're avoiding the conversation entirely. For others, it starts as procrastination, one missed deadline that becomes 2, then 5, then a decade of unfiled returns and compounding penalties. The IRS doesn't forget. It doesn't have a statute of limitations for fraudulent non-filing. And while the agency can eventually construct a return on your behalf using third-party data, it already has. Those substitute returns are built to collect what's owed, not to minimize what you pay. Every legal deduction you were entitled to gets ignored because you weren't there to claim it. The penalties stack. The interest compounds monthly. A manageable tax bill from several years ago becomes a number that can genuinely alter the trajectory of someone's financial life. And at the point where investigators determine the failure to file was willful rather than negligent, it stops being a civil matter and becomes a criminal one. The threshold for proving willfulness is lower than most people assume. Repeated non-filing across multiple years is essentially its own evidence. Here's what makes tax fraud genuinely fascinating from a systems perspective. The IRS doesn't audit randomly. It runs every return through a scoring model that flags statistical anomalies. Your return gets compared to millions of others at your income level, in your industry, in your geographic area. If your numbers look normal, you're invisible. If they don't, you get a second look. Most people who commit tax fraud believe they're too small to matter. And statistically, in any given year, they might be right. But the records don't expire. An audit can reach back 3 years for mistakes, 6 years for substantial underreporting, and indefinitely for fraud. The person who skimmed cash from their restaurant in 2019 and forgot about it isn't safe. They're just not caught yet. And the consequences aren't just financial. Tax evasion is a federal felony. We're not talking about a fine and a stern letter. Conviction carries prison time. Real prison time. Al Capone, one of the most feared criminals in American history, wasn't brought down by murder charges or racketeering. He was brought down by tax fraud. The government couldn't prove the violence, but they could prove the money. That's how seriously the system takes this. The paper trail is always more prosecutable than the crime underneath it.